hedge inflation. Inflation has been on everyone's mind. You think about it every day when you go shopping for the basic needs such as food and gas. The inflation rate is currently at a high of 6.8%. In 1981, the inflation rate was as high as 12.47%. There are many reasons for this high rise in the inflation rate. 1. Increasing energy price. 2. Supply chain issue. 3. Increasing in cost. 4. Increase in money supply. 5. Short supply and increased demand of certain goods and services which were held back due to the certain unforeseen forces or pandemic. 6. Increase in money supply. 7. Monetary policy. 8. National debt and deficit financing. The central governing authority and the Bank of Canada has taken the aggressive move of increasing the prime rate in order to subdue the rising interest rate. High rates means people will be encouraged to save and discouraged to borrow and spend money. This will reduce inflation to a more manageable level. What type of investments is at risk? Bond, in general, have been used to reduce volatility and risk. This is especially true with long-term bonds. With inflation high and the central authority's decision to raise the interest rate, bond is no safe haven. Any return expected in bonds can be reduced. How to protect against inflation? There are ways to protect against inflation and outperform the market. 1. Fixed income. 2. Equities and stocks. 3. Commodities. 4. Real estate. 1. Fixed income. Short-term bonds is not as risky as long-term bonds during a high inflation environment because their prices are not vulnerable to the changes of the interest rate. Treasury inflation-protected securities, TIPS, and real return bonds are indexed to inflation in order to protect investors from the devaluation of their currency. They are a type of government-issued bond to protect investors from inflation. Floating rate loans, convertible bonds and high-yield debt or other type of fixed income investments that can help too. They have done pretty well in the past during a high inflation environment. 2. Equities and stocks. There are many types of equities and stocks, especially preferred stocks, and some will fare way better when inflation is high. Here are some that can perform well during inflationary period. It is best to diversify in industry and region. Try investing in energy, material, infrastructure, real estate or REIT. Try to find stocks where the companies are able to pass the cost to end users and still retain high profits. They would have a strong cash flow in their books. This is a good strategy to hedge inflation. These companies can increase their prices naturally during high inflation. 3. Commodities. Commodities have been another good way to hedge against inflation. They have low cost of production and a strong cash flow profit. You cannot go wrong with gold during high inflationary period. As the dollar depreciates in value and loses its value, gold has appreciated many times over when inflation is high. Look for oils, energy, industrial metals and precious metals. Wait, pork bellies? How did they get there? Please delete pork bellies. You should watch Trading Places with Eddie Murphy and Dan Aykroyd. Lots to learn about commodities. 4. Real estate. As prices increase in gas, food and rent, people who invest in real estate often benefit during inflationary period. They are able to increase the monthly rent of their property. It is a good inflation hedge because there is a high demand for homes. It does not matter what the economic situation. People will need a place to stay. As inflation rises, your property value will also rise.